Welcome, everyone. We are hoping that everyone can see us, hear us. There is a chat option within GoToWebinar. So if there's any trouble, please do message us in the chat, in the little chat box there, and we'll look out for that. This is the Energy Special Interest Group. It's our first meeting, and I just wanted to welcome everyone. I'm the chair, Alexander Larson. And we've got a few presentations coming up today, and we have a panel session, and then I'll close it off with a little briefing about the group and what we'd like to do next. So as I say, I hope everyone can hear us. No one's mentioned anything in the chat yet, so I don't know if that's a good thing or a bad thing. I'm just going to share my presentation. There we go. Okay, I'm hopeful that everyone can see this presentation now. I've just opened it up. We were playing around. It's interesting having 4 or 5 people needing to share their screens and jumping between them, but we'll get there, I think. So again, welcome everyone, and hopefully we have a successful session today. And I'd like to just cover a few items on the special interest group. So there's many special interest groups. For those of you who aren't aware of the Institute of Risk Management, there's quite a few special interest groups that cover a number of risk areas such as risk and complexity, charities, IRM and financial services, and so forth. And you can see that on the screen. We are obviously focused on the energy group, although we do have the climate change special interest group chair here as well, Martin Massey, who will be speaking on climate change. You'll notice on one of the graphics there is Fueling the Debate. It's a publication. This was our very first energy group publication. It was based on a massive survey we did on the latest risk management trends in the energy sector for 2019. That's available on the IRM's website. So you'll be able to get a bit of a feel about the group and what we're trying to achieve by reading through that. There was a lot of interesting articles shared within that publication. So one of the key aims and objectives and activities that we're trying to do as part of the energy group is we're trying to inspire, learn from each other, engage people, do research and collaborate. And you can see a little bit about what that means in the topic there. We're trying to achieve active thought leadership. In other words, we are trying to get people involved to provide their insights, and that goes hand in hand with the learning, discuss and write about specific areas of energy, risk, sharing knowledge through our members. Again, we're bringing experts in to present, but we're also looking for our members who are experts themselves to contribute as much as possible. We're trying to engage through a series of energy events. So this is our first event, but we're also going to be having networking meetings where just as groups we'll get together, and maybe there'll be even subgroups where we'll get together and discuss specific topics only as members rather than having a panel and experts coming in to present. We are also doing research by commissioning surveys, both within the Institute of Risk Management and on emerging energy risk trends. But we're also trying to get partnerships with, for example, the climate change special interest group or the regional groups in the Middle East or in Scotland, for example, that are more driven by oil. And we're trying to collaborate a bit there, which obviously leads into the collaboration bit at the end. And just to introduce the Energy Special Interest Group team, the chair is myself, Alexander Larson, and we have a new deputy chair that's literally just been put into place today, and that's Grant Griffiths. We are looking for a secretary, and there's also the Energy SIG committee. We do have a very solid support team. Victoria Robinson, she is involved in everything to do with marketing of events and articles that we put together. And again, we encourage people to write articles for us, and then hopefully we can get them published in the IRM magazine. Rory Poole and Juliet are the event organizers. They support us with the webinars and the technology for us to actually run these sessions. So thanks to them as well. Now, as I mentioned, this is the first Energy SIG event, and what we're going to be talking about are some really topical subjects. We're going to talk about the current crisis. The current crisis is, of course, COVID-19, the lockdown itself. COVID-19 obviously kick-started this whole thing, and whilst, yes, the pandemic was difficult, it perhaps wasn't as difficult as the lockdown itself. That's really been the major impact. Alongside this, of course, is the oil crash. And then we're going to look at future crisis, challenge, and opportunities, specifically around climate change. And obviously, we know that there's going to be a recession coming as well, so that forms another aspect. But really, we're going to look at, we all had this climate change as an agenda. How is this going to change? Why is it still important? And with that, I'm going to pass you on to Grant, the Deputy Chair, who's going to introduce the speakers, and hopefully we can kick off the presentations. And do bear with us as we work with the technology. I think most of us are used to certain platforms. This is a new platform for us to work with, but we'll get there, I think.
Yeah, I'm sure we will. Thank you, Alex, and welcome to everyone who's joined us today. We hope that you'll find this event useful, helpful, and very relevant. And we're very privileged, I think, to have such an esteemed group of panelists and speakers joining us today for this event. And it's very timely given recent events. And I'm not just talking about COVID-19 when I say that, but today's event, I think, for the Energy Special Interest Group couldn't be more timely. So kicking it off, first of all, we're going to have a presentation from Gavin Thompson. And just to introduce Gavin, Gavin's the Vice Chairman of Energy for Wood Mackenzie's Asia Pacific business, and he's joined Wood Mackenzie in 1997. For a few years, from 2000 to 2003, he managed their Asia Pacific energy markets team and was based in Beijing for a number of years, managing their China business, and led the company's energy research efforts in China. He spent a couple of years in Tokyo, heading Wood Mackenzie's gas and power research across Northeast Asia. Then in 2016, Gavin returned to Beijing to manage Wood Mackenzie's overall China business. For the last few years, he's been head of Asia Pacific Research, leading a team of over 100 analysts. And in early 2019, he was appointed as vice chair of the energy business for Wood Mackenzie in Asia Pacific. He's based in Singapore. He's a regular keynote speaker at events across Asia Pacific. Now, one thing I didn't know, in addition to having extensive experience advising companies on strategy development and implementation, he also runs the APAC Energy Buzz blog, and it's a widely read thought leadership piece, which is respected right across Asia. Gavin graduated from Newcastle University with a first-class honours degree in politics, economics, and Chinese language. He'll be sharing his insights on the impact of the crisis on upstream strategies for oil and gas companies. So with that in mind, we'll just hand over here to Gavin. It's all yours, Gavin. Welcome.
Okay, Grant, thank you very much. Can I just ask what you see on your screen? Can you see the PowerPoint, or can you see some notes? Yeah, they should be able to see the PowerPoints. Okay. Let me just make this full screen. Okay. Okay, so while I begin, thank you for the introduction, Grant, and hello to everybody who's dialing in. It's not easy to know exactly what to cover in 10 minutes or so, given just so much that's been happening in the global energy market in the last 2 or 3 months. So I decided to take a macro view and to give an introduction to what we think is happening with the oil price and with oils and gas supply and demand, but also really importantly, how we think companies are responding. So looking first at oil demand and oil prices, we all know that the OPEC Plus failure to agree on production cuts in early March sparked a major crisis in oil markets, collapsing prices and leading to a supply glut into the market. And as prices spiraled, action was desperately needed to bring some stability. And the subsequent OPEC Plus agreement, which was announced on 12th of April, I think, to cut almost 10 million barrels a day of supply through May and July, and that will step down a little bit through subsequent months, but will last until the end of April 2021. Yeah, even if that is not fully implemented, and I think we may want to discuss implementation and compliance, we think it's large enough to have an impact on supply and demand fundamentals through the duration of the agreement, which is really critical. And so if you'll let me just jump ahead until that agreement comes in, we would now expect that through the second half of this year, that we will see a global implied stock draw. So that's to say that we'll start to see demand, including through inventories, outpacing growth in supply. And that's what's needed, of course, to rebalance the market. Right now, that feels a very distant prospect. And that's because the short-term market is clearly incredibly oversupplied. And with the WTI futures trading in negative territory earlier this week, we've all seen the headlines, albeit at a very low volume. Those price signals are now meaning that we're moving from the opportunity to curtail individual wells to potentially closing entire fields and entire projects. So I put a couple of pictures on the screen as I just put aside the OPEC Plus cuts for a short time. And we look at the US lower 48, which is really where the market is focused right now. About a week ago, we expected that onshore crude production from the US lower 48 would drop by about 900,000 barrels a day between where we are now and the end of the year. And one of the Wood Mackenzie sister companies, Genscape, had calculated at the beginning of last week that shut-ins that had already been announced would add up to about 240,000 barrels a day of lost production through May. But a week right now is a long time in the oil business, and these announcements have been coming in very quickly over the past few days. We all know, of course, that there is huge pressure on storage capacity. That's what's been driving up prices. And the physical crude market in the US is priced into negative territory. So if you look at the charts on the screen, you'll see that the rig count has already fallen precipitously. The Permian rig count, over about a quarter of all rigs have been laid down over the past 5 weeks. And it's going to continue to happen. And then, as you can see on the right-hand side, this means that production is going to continue to decline. And this could get up to about 3.5 million barrels a day of lost production by the time we get to the end of 2021. So that's where we are right now, and that's a very, very negative story, putting a lot of pressure on companies. But if I look a little further ahead, we will come out of this crisis. Economies will recover. It's what they do. And at WoodMac, we assume that lockdown measures do remain in place through many countries through May into June, and then ease slowly in the following months. And if this happens, and I accept that that's a big if, then world oil demand will fall by around 8 million barrels a day year on year during Q2, with the sharpest drop this month at 15 million barrels a day. Now, it could be worse, but that's what we're currently holding. So in terms of prices, I sort of want to push back a little bit on the negative, very small trade amount of forward prices that saw prices in negative territory. We think we will get some recovery in Brent, particularly through June, as we start to see some demand pick up. We might hit the $30 barrel range, and clearly a stronger recovery through the second half of the year. And so we could be in $35, $40 a barrel territory by the end of 2020. And that should continue to grow in particularly Q1, Q2 2021, when we get that rebound that we're all looking for the signals. Now, in terms of gas prices, very quickly, the story for gas is a little bit different. The fall in spot LNG prices, we've been anticipating that for some time. Northeast Asian spot prices in September last year were already about 60% lower than the same time in 2018. This is about oversupply. We've seen this coming, but it's been hit harder. The supply is still coming into the market, but we've got weaker demand. China has been weaker in particular. What it's meant for prices has been more extreme. So we're seeing Northeast Asian prices delivered around $2 per MMBTU, and a saturated European gas market sinking TTF prices at the Henry Hub price. So with supply still growing, clearly, you know, the last mechanism the market has is to take out some of that US supply. And to date, it's been very, very limited. But look at the numbers. I really would encourage you to look at the numbers. Producers need to be shutting in some of the producers in the US, for example, are shutting in associated gas, and Henry Hub is going to respond to that. And Henry Hub is currently rising, but global gas prices are dropping. So if you look at the numbers, the TTF convergence with Henry Hub has already occurred. So the economics of US LNG is clearly out of the money. And this summer, that's summer 2020, European prices are not expected to really even cover the regas and the shipping costs, and are hitting into the liquefaction and tolling range. Now, what does it mean for companies? I think in terms of the corporate response, it's not the first time we've seen a price war. And on the face of it, we could argue that the industry appears better positioned this time round. At the start of this year, the 50 or so companies in Wood Mackenzie's corporate benchmarking tool needed an average Brent price of about $53 a barrel to break even, including dividends and buybacks. So does that mean that it's not as bad as it was in 2014-15 when prices fell from $100 a barrel to around 30? But actually, we think it could be worse, because this isn't just a supply problem. This is also a demand issue, with demand evaporating as we speak. And just like last time, the global upstream industry is saying, well, how can we respond? Our cash flow is being decimated. So if Brent averages $35 a barrel this year, then we think up to about $380 billion of upstream cash flow will disappear. And that's compared to a flat price of $60 a barrel, which was the year-to-date average prior to the oil price crash. So oil and gas companies have responded. They've started a major wave of cost cutting. And of course, discretionary spending has been slashed, including buybacks and exploration. And US tight oil, which I've mentioned already, it's not alone in feeling the pressure. And the chart which I'm showing you on the screen is showing all those unsanctioned conventional projects which could have taken FID in 2020, could have had a final investment decision. And you can clearly see that at $50 a barrel, at $60 a barrel, most of those projects would have been economic at a 15% discount rate. Where we are today with Brent dipping under $20, almost none of those projects are moving ahead, and they're all going to be postponed, delayed, or cancelled. Externally, capital support for the industry is absolutely critical, but it's limited and it's expensive. And the upstream M&A market is also at record lows, with most of the obvious asset sales already being made. So my final question really is how much will be cut? It's still early days, and I think the numbers are going to continue to move. Our headline number is around 25% cut for the year versus previous estimates. And if that seems modest, I would remind you that that includes the entire first quarter, essentially as business as usual. So we've seen most of the majors announcing cuts in the range of 20-25% versus full year budgets. This isn't the end. We've already seen some other companies going further, revising and cutting deeper. So I think the risk is very much to the downside currently. Okay.
Great. Thank you, Gavin. That was that's very insightful. I've also just sent a note out to all attendees. Any questions, please put your questions into the question box, and we'll come back to those as part of the panel session following each of the individual speakers. I think it's very interesting to see the break-even price points there, Gavin. I think it's something that, you know, many people don't quite realize. We're going to get a further insight now on the markets and what they're doing. So our second speaker is Chris Midgley, and Chris is the Global Director of Analytics for Platts, S&P Global Platts. I think I've got it right, Chris. I always knew it as Platts for many years. It's a division of S&P, and it's a leading provider of information and data for the energy and commodities markets. Chris is also a member of the Platts Executive Committee, and he has over 25 years of oil industry experience. Now, during that time, he worked for around 20 years with Shell in manufacturing, supply, and trading and strategy, heading up Shell's oil markets analysis division, and he developed long-term outlooks to support the group's investment decisions. So you can see that Chris has quite a good insight as well, following on from Gavin, into these things. Chris has also been a director of a number of shipping and oil-related companies. Based in London, Chris leads and executes a strategy for analytics and provides data to support customer strategic decisions. Chris is also leading the building of S&P Global Platts Analytics solution. I think Platts and S&P collectively have made a number of acquisitions over the years, and there's some names there like Pira Energy, Rig Data, Eclipse Energy, Seaflow, and Bentech Energy, to name a few. So Chris is tasked, I think, of leading the team to bring all of that together. Chris is a chartered engineer. He has a degree in chemical engineering from Loughborough University. So Alex, if you could help me in switching over to Chris, that would be great.
Well, Grant, thank you very much for the introduction. I'll start talking while we try and get this going. It's certainly been a period of record events in the market. So hopefully, if all goes to plan, you'll soon see my screen. And I think to complement where Gavin left off, I mean, you know, there may be some things that Gavin and I might debate on around, you know, some of these cuts, how deep the demand is going to be, and I think I look forward to that conversation afterwards. But what I'm going to try and do in a sort of 5-7 minute sort of whirlwind is just give you a little bit more slides, a little bit more background as to what I see happening in the market right now. And so one of the things I think it's worth us first stepping about when we think about risk, we've forgotten where this maybe all started. It all started with a little bit of a spat at OPEC, which was really being driven between Russia and Saudi Arabia, questioning whether they wanted to continue to provide price support to the market or whether they wanted to have volume share. And what we saw very much in the early stage of markets collapsing was that OPEC plus it decided that they wanted to go for market share. You can see on this chart that, you know, OPEC had lost its share in the market, and between Saudi Arabia, US, and Russia, they basically supply over 45% of global oil to the market, or liquids, hydrocarbon liquids to the market. And so inevitably, you know, having supported this growth of shale, and with Saudi Arabia and Russia having the lowest or some of the lowest cost production, Russia eventually said enough is enough. Why are we helping the US shale producers continue to produce and flood the market, as they would look at it, and at the same time get hit by the US with sanctions, whether that's on trading companies like Rosneft or whether that's on sanctions on the Nord Stream 2 gas pipeline. So this was really where some of this started, and we shouldn't forget that that geopolitical tension still exists, even though we now have a new agreement, which is now being termed OPEC plus. Let's then look at what then happened after that. So having had oil prices collapse after OPEC plus decided they were going to turn on the taps and go for market share and add 3 million barrels a day more oil onto the market. Of course, just a week after that, effectively, the World Health Organization declared the coronavirus as a global pandemic rather than an epidemic which was affecting individual countries. And over the last couple of weeks, we've basically seen the world go from a third of the world in lockdown to 2/3 of the world in lockdown. And as you can see on this chart, that transition of dark blue, which now shows the whole world in lockdown. And this causes huge risk to the demand outlook, and the fact that now you're including Latin America, you're including India, you're including Africa. When it was OECD countries, you could understand how you could go through lockdown. They had the fiscal whereabouts to be able to manage, keeping the country locked down long enough to probably deal with the virus. Now, when you go to more developed countries, they can't stay in lockdown for long periods. They will keep on probably bringing the lockdown out too early, and we're likely to have repeat events, second waves of the coronavirus, which is why perhaps, versus Gavin, I think a bit more optimistic that we'll get through it. I think we're likely to see waves that continue through the year and even into 2021, which could impact demand. And of course, we've seen the IMF come with very, very pessimistic views of global GDP impact of this. So look what's happened to the oil price, and more importantly, as Gavin talked about, commodity prices overall. We started with OPEC Plus falling apart, which was the first drop in oil price, then coronavirus. Then we got a little bit excited at the beginning of April that this OPEC Plus deal was going to be supportive of oil prices, only for this week for it really to unravel right true and proper. And as I put it, oops. There's really no other way to describe what happened to WTI. If you are basically selling into a vacuum, there is no price. Let's not overplay that, because look what's happened to the price since it's recovered. In fact, today it's up 20%. But what's interesting, you've now seen good conversions between the physical contracts of WTI and dated Brent, where they've come together. Much more interesting in my mind is to look at the fact that every single commodity is below coal price today, which is an extraordinary event in itself. So you've got WTI, Brent, and now you've even got JKM trading below Henry Hub. So a lot of things that we could talk about there. Also have a look there at the green line, ethane. That's another interesting commodity, in fact, because it affects petrochemicals. It's increased in price, and a lot of that ethane has been being dumped into US natural gas, which is why US natural gas originally fell and became weaker. But to Gavin's point, to see with more oil production being reduced in the US, we're going to see about 8 BCF of gas production being lost, and therefore we're starting to see Henry Hub actually be the one commodity that's likely to perform. We can talk much more about that chart in a little bit. I like looking at the US. US always gives us good data, but this data is looking at the DOEs that comes out every week. But you could probably put this image out there for Europe or for India or anywhere else. What's happening around the world? This tells the picture. Oil demand into refineries is collapsing because refineries have no demand, and so they're reducing their runs. We're now 20 million barrels a day of refinery runs have been reduced. 14 million barrels of that is associated with the coronavirus versus your normal underlying maintenance. So that big drop, as you can see now, of refinery demand leads to crude stocks increasing, and you can see that. And as we know, Cushing is now just 3 weeks away from being full. This is one of the reasons why the WTI contract came under so much pressure on its expiry. But at the same time, you can see here gasoline stocks are continuing to rise because of this huge destruction. 80% of passenger vehicle demand in the US has been decimated as a consequence of everyone staying at home. But it also tells you the fact that gasoline stocks are going up. We're running our refineries faster than demand, which means we're consuming some crude in order to store products. So you have to look at both the product stocks and the crude stocks to understand what's going on. Distillates, on the other hand, remains relatively strong. Industrial demand, less heavily impacted. We still have a lot of commercial road transport activity, but even there you can now see on the chart that distillate stocks are rising. Again, a suggestion that your refineries are running faster and at higher rate than the demand for their products right now. And of course, a lot of the distillates is coming from the fact that we've seen jet demand, down 75% cut in aviation, 45–50% cut in jet fuel demand, which of course 70% of that jet ends up in the diesel gas oil pool. So the problem that we're facing, and what OPEC Plus and OPEC Plus was trying to achieve, is this huge imbalance between supply and demand. And to Gavin's point, yes, the demand should recover, but at what rate will it recover? I think this is an optimistic view. I mean, it's more of a graphic. We have a much shallower growth trajectory. But what this shows is before the at the time they were trying to make the decision around cutting crude and OPEC cutting, you can see that from the stock levels, the stocks were going to exceed the total capacity of storage by the middle of May or some point in May. And that was utilizing a lot of floating storage, ships to store oil, as well as converting a lot of the crude into products and having product storage as well as crude storage. So this was the challenge facing Saudi Arabia and Russia, was what do you do? And the reality is at the oil price we were at, Russia was uneconomic, below $20 a barrel. Some of its marginal crude wasn't economic, and we saw that Russia failed to increase their production despite the failure of the OPEC Plus original agreement. So it's not surprising they wanted to try and cut and rebalance. What did they agree? This is a slightly different way of looking at it, but they agreed 9.7 million barrels a day of cuts based on an October 18 baseline, although Russia and Saudi decided to choose 11 as an arbitrary baseline for themselves. Versus what their commitment was for April, you could argue that's a 12 million barrel cut if you add the fact that April production was higher. But it still, in our mind, leaves somewhere around 5 million barrels potential of other curtailment outside of OPEC and Russia. And also, we heard Donald Trump saying they achieved 20 million. The fact that risk now is based on an individual's Twitter account, I think, brings new dimension to risk management. But clearly, one of the things they added there was the 200 million barrels of SPR storage, which effectively can generate 2 million barrels of implied demand if we fill all those SPRs up. So a number of interesting factors that then come in because of SPRs, of course, government managed, again, a different piece of risk. Last few charts, just look what's then happened to dated versus ICE front month. Actually, this is looking at structure of ICE versus the structure of dated. But what you can see is the dated has disconnected itself from the front month futures contract. Why? Because there's just no physical buying. This is what happens to future contracts if they're not cash settled, which was what happened with the WTI, because it settles on a physical delivery. You basically were selling into a vacuum. You've got the physical market lacking buyers, and so physical contracts like Brent, dated Brent, the Platts dated Brent quote, is under pressure. But we've seen recently, after the WTI collapse, what's interesting is WTI and Brent has come close together, but also front month ICE futures has come closer. We've seen a narrowing of ICE front month to Brent dated, and in fact the ICE front month to the second month has widened. So what it's telling us is the market realizes it's going to be long supply for at least another 2 or 3 months, and therefore I would stay very bearish over the next 3 months. That use of all that floating storage has sent freight rates skyrocketing. You can see short-term freight market very volatile, but that's the fact that people are taking on ships in order to use them floating storage. If you take them on for 1 year, you can get a better rate, but you basically need the 12-month calendar strip contango to be at something like $1.60, $1.70 per month over 12 months to make a one-year term work. And so, so one of the things I think is interesting in this market is just understanding there's a whole lot of dynamics playing out here. You've got Canadian oil, which is trapped because there's no demand from refineries in Pad 1 or Pad 2, the east coast and central part of the US. Cushing, the main hub for oil in US, is full. It's dysfunctional now. You've basically got everything trying to get to the US Gulf Coast, but all those pipelines and all the oil competing. And therefore, we will see significant curtailment, probably about 3.5 million barrels a day of oil supply in the North America being reduced. Not because of the lack of capex spend, not because of rigs, not because of fracs necessary, although that's contributing, but as Gavin says, that doesn't help you till next year, but because there's just no way to get the oil out. And then we're going to have shipping becoming really congested as we see lots of Saudi arrivals in June going into the US, lots of crude trying to go to where the demand is in China, and at the same time, you've got the Middle East trying to compete to put as many barrels in there. So we're going to see pressure on this market lagging all the way into June. This is going to play out because of the dynamics of this market. So I want to leave it there. Just to remind, at Platts Analytics, we provide real-time analysis every day to our subscribers. But if you want to take a little look, we've got our Platts Live platform where you can take a look at a lot of the free online information, which is readily available at your fingertips. A little plug just to finish. Thank you.
Thank you, Chris. That was an excellent insight. We moved cleverly there from upstream, midstream to downstream. There you go, just across two wonderful presenters with a wonderful collective wealth of knowledge on the global markets. Thank you, Gavin and Chris. And, we're talking there quite a bit now about demand and about the demand side of things and people in cars, not in cars, heavy transport. And earlier on, Alex spoke about, the challenges of things like climate change. Well, before COVID-19 came along, we were all talking about climate change and about energy transition and about the whole new world and about moving to electric vehicles by 2030 or 2035 or 2040, all sorts of things, presenting a whole host of challenges for the entire value chain in the energy sector. So our esteemed colleague here, who chairs the Climate Change Special Interest Group at the Institute of Risk Management, Martin Massey, Martin is going to present now on climate change. So very important and emerging part of the whole energy story. Martin's worked in the risk management profession for over 25 years. Now, Martin's background includes working for some of the leading global insurance companies such as Swiss Re, AIG, and Star Group. And he's also worked within the risk consulting practices of Marsh, Aon, and Willis. He's a leading enterprise risk management practitioner with a strong technical background, actually doing things that I don't understand, like actuarial science and risk financing. Martin holds 2 professional risk management qualifications, and he has an MBA from Kingston Business School. He was appointed to the chair of the Climate Change Special Interest Group, and he has also lectured and taught at the Enterprise Risk Management School at Georgetown University in Doha in their community program. So Martin, we're looking very much forward to hearing from you, and particularly from a climate change angle.
Hi, thanks Grant, thanks Alex. Can you hear me?
We can hear you, see you, and see your presentation.
Excellent, excellent. Yes, okay. So I'm going to talk about obviously different subject, but related in terms of some of the emerging threats facing the energy sector. Interestingly, obviously the current pandemic crisis to some degree is a foretaste of what we might expect from a climate crisis in terms of simultaneous shocks to supply and demand and disruption to supply chains. And as Grant mentioned, there was a lot of focus, or has been a lot of focus on climate change, and business have been in the process, or need to be in the process of investing in strategic, operational, and financial resilience. And I think the word resilience is pretty key now going forward, both in terms of adapting to the new post-pandemic world. So climate change is similar to, as a backdrop, is similar to pandemic in that they're both been grey swans, or they are both grey swans, in the sense that everybody was predicting them or are predicting them to happen, but they generally, the world is ill prepared to deal with either. So I think it's a bit of a wake-up call, I hope, for the industry, or for the global economies actually, and governments now, that something has to be, there'd be more of a focus now on dealing with climate change and investments over the next decade to build more resilient infrastructure and transition to a low carbon economy. And I think actually for the energy sector it's pretty important in terms of driving economic activity, job creation and environmental resiliency going forward. So I'll just move on to, if I can, to my next slide. 1 second. Okay, so in terms of the aims and activities, quite similar to, as Alex was saying, for the energy sector, for the climate change special interest group, we only formed in the back end of last year. And one of the key outputs that we're trying to drive is thought leadership. So we're looking to develop a practice guide for risk managers by the end of the year. And I've been asked by the Institute of Risk Management, hopefully to present that at the Risk Leadership Conference in November. Some of the other activities that are pretty important clearly are to how do risk practitioners embed IRM into their existing frameworks, and what are the tools and techniques that are available to risk practitioners. And we're in the process now of sending out risk questionnaires on a quarterly basis. And I think it'd be great if we can collaborate with the Energy SIG to get your feedback, and so that we can get a wider feedback from both from a global perspective, but also from different industry sectors. Because the most of the focus that I've been involved with so far has been with the financial services sector. We are clearly looking to collaborate as well. There's a lot of organizations involved in this area, and it's very important that we seek to collaborate and work with different organizations. So we held our first event actually only a couple of months ago, and that seems a long time ago now. We did focus primarily on the financial services sector. We had the Bank of England presenting, and I think it was very, very timely and very important to have them involved, because there is a lot of pressure from regulators now, and they give quite good guidance. And one of the core messages was really that it's better to get to work on developing, for example, scenarios now and get them approximately right, and then develop them over time. So really, the key message really is that climate risk assessments need to start now and need to start planning now. And obviously, a lot of companies are, but it's some of the time horizons are quite extreme. Oliver Breen from Nationwide's on the committee. He's actually responsible for climate change within Nationwide. And one of the key roles of risk management, as with all emerging risk, is really to break down the complexity of a problem and provide information to boards for decision making. And that's a common theme that I'll try to bring out as I go through the slides. As I mentioned, we are sending out questionnaires to members. There's also the potential to develop a climate change training course, or maybe a certificate, something that I'm discussing with the IRM at the moment. It seems to be quite a lot of interest because of the complexity of this subject. So, going back to basics, World Economic Forum, as probably everybody knows, when they produced their global risk report at the beginning of this year, the top 5 global risks were all environmental related, 3 of which were directly related to climate change, and the top risk was actually, or the top connected risk is extreme weather events and failure of climate mitigation and adaptation. I think that those 2 global risks are often misunderstood. It's very important to differentiate the 2 effectively. Obviously, coming from the insurance industry, we're seeing, or have been seeing, a lot of upward trends in both frequency and severity of extreme weather events, and obviously failure to adapt to mitigating climate change is actually going to continue to increase that trend. So interestingly, we now are in the middle of the pandemic, and we'll need to reassess. Obviously, World Economic Forum are now looking to reassess global risks in light of that. And I think Alex mentioned the point about moving into a recession. So it's going to be very complex for organisations to try to, if you like, multitask around these future events and how to deal with them. But I think the most important thing is that climate change still needs to be looked at as a key risk to manage and mitigate, even though we're in this crisis with pandemic. So what are the impacts of climate change? As Grant mentioned, I used to work for Swiss Re, and they do a lot of research, obviously, in looking at catastrophe events and emerging threats. There has been a significant increase in catastrophe events over the last 30 years. Interestingly, about 75% of insured events, global events, are related to storm and flood events. And if you recall, probably, I know we're looking at the sunshine now in the UK, but a couple of months ago we had major floods, and it's an area that clearly is having impact across. Sorry, I'm having my dog bark in the background. That's one of the. I'm going to have to shut my door 1 second.
So even the dogs are on the climate change topic. It hasn't gone to the dogs; they're just interested.
Sorry. Yeah. So from an insurance perspective, it's a big issue, and interesting now, even with the pandemic, the insurance industry is struggling now with looking at business interruption claims. So there's a lot of issues now for the insurance sector and the banking sector to focus in on this area. If we look back to Hurricane Katrina, actually, it cost the US economy $105 billion. And it also taught us that, disaster risk reduction and crisis management planning is a very much a people-centered and must engage all parts of society. So there's a lot of commonality there as we're looking at the pandemic crisis at the moment. I think the IRM framework, the IRM function, I should say, is very important to help organizations look at risk aggregations and accumulations. And again, I think that's a common theme, that when we look at issues such as pandemics, such as climate change, you have to have a sort of a wider, you have to think sort of a bit left field. You have to think about how these risks are aggregating across different exposures and how they're accumulating. And that's a very important role of the risk profession. So moving on, in terms of reactions to climate change, in the last year we've witnessed a definite step change in momentum, as something that Grant and Alex mentioned. In respect to the energy sector, there's been recent announcements from British Petroleum, from Bernard Looney, was pledged to get to net zero emissions by 2050. In his words, the world's carbon budget is finite and is running out fast. So something has to be done. Clearly, also to meet these energy targets, companies have to reduce existing. Looks like they're going to have to reduce existing production over time, develop new technologies to capture carbon, and obviously move to renewable energy sources. Clearly, there's some major investments now to move certain sectors to, for example, the car industry, to electric, etc. A lot of companies, you see there, Goldman Sachs and other major financial institutions are investing in clean energy projects. So there's sort of an important, it's a very important time now but to actually look for all organisations to start reducing their carbon emissions. So what are the key challenges for risk managers and boards? So I had a sort of a brainstorm myself looking at this. It is a very complex area for the risk management function and also for organisations to tackle. And I think there are 5 key areas, and these are the areas that we'll be focusing on as a special interest group, and hopefully can collaborate with the energy group and some of the other industry sectors as well, because it does cut across all industry sectors who are trying to tackle this problem. First of all is complexity. So complexity of risk. So when people talk about climate, that's not really the risk. Climate is pretty much a trend. So it's trend in global warming and in sea level rises. But actually, there's a whole complex array of risks which we'll look into. Competing priorities. Interestingly, we've had discussions now about the impacts or knock-on effects, if you like, of the pandemic in the energy sector to oil prices. But there are a lot of competing priorities, and trying to integrate those into your IRM framework and govern those is particularly complex. There are a lot of external stakeholders actually looking at changing the behaviour, if you like, of organisations, regulators, rating agencies. Obviously, we just had a presentation from S&P. They've got a separate assessments now on climate change. Some of the other regulators looking at this. Obviously, investors, a big area of focus now is on investors who are looking for reductions in greenhouse gases and movement to renewable energy. And when I was at NSTAR last year, we did a big exercise looking at our investment strategy, knowing that we would have to change our investment strategy internally. So that's one of the stress tests that we were looking at. But a lot of that was external focused issues that we were having to tackle. And risk disclosures, how we disclose climate change within your financial statements. Horizon scanning, time horizons is critical. And we'll talk a bit about scenario analysis a bit later in my slides. You know, tragedy of the horizon is a problem here for when you've got these competing issues, short-term and issues or medium-term issues. Climate change is very much, as we've seen in the previous slide, something that has to be looked at over the next 10, 20, 30, 40 years. It's something that we're not used to dealing with, and that's what makes it complex. Probably the most overriding area of why organizations are looking at dealing with this problem is around reputation, brand, franchise. So focusing on the environment, social governance, ESG, strategies, risk, and obviously opportunities as well. So I'll try and sort of cover some of these areas in the next few slides. First slide here is the new taxonomy. I think the good thing is there's a lot of across the world now, and with regulators looking at this problem, there's a lot of commonality in looking at a breakdown of the risks. So physical risk, transition risk, and liability risks. And this actually is a slide that was produced by the Australian Prudential Regulatory Authority. Firstly, physical risk includes direct damage to assets and indirect impacts from supply chain disruption. Transition risk, which relate to financial risks of transitioning to a low carbon economy, which will include policy actions, technology changes, and market responses. And interestingly, for the energy sector, they really tried to figure out how current business models based on burning fossil fuels can be transitioned to more sustainable and comply with the Paris agreements in the low carbon world. Lastly, legal risk or liability risks cover the failure of organisations actually to mitigate impacts of climate change and failure to adapt. And the energy sector, interestingly, is because of the historic nature of focusing on fossil fuels, as now sort of bearing some of the consequences of now being targeted by governments to account for some of the conduct. And there are a lot of class action lawsuits around the world in relation to this impact on some of the major oil companies. There are clearly also a number of emerging associated climate change risks, including human and social risks, that we're also seeing in relation to the pandemic. So if we move more to look a bit more deeper into physical risks, I suppose this is the area of expertise that I've been working on in my career. What's interesting is to break this problem down into looking at event-driven acute and long-term shifts, which are termed chronic. So most people associate physical risk with individual events such as storms and floods, loss of life, physical damage. But actually, there's a lot more focus now on climate change causing chronic risks and shifts, which effectively long-term risks to supply chains and increasing in operational costs. As an example, I'm doing some work now with the agricultural sector, and a lot of the agricultural producers, they can't buy insurance in lots of parts of the world, which is actually a problem for society due to droughts, due to high temperatures. So they can't actually protect their crops. There aren't any insurance solutions. So in terms of development, on the right-hand side, one of the classic, if you like, risk management tools that I would advocate a lot of risk practitioners to adopt is the bow tie approach, which really looks at proactive loss controls and then reactive post-loss controls. So clearly, when you take flood, for example, I've had recent meetings with Flood Re, government-sponsored reinsurance company in collaboration with the insurance industry to provide protection for UK properties. So there's been a lot of work done, as people are probably aware, in the UK to prevent flooding. And so it's all the types of controls that we can look to do to reduce the impact of controls, the flood defences. And an interesting example of that is obviously Thames Barrier. It protects 150 square miles or kilometres of land, which protects about a trillion of property value. So it just shows the importance of some of the protections that were put in place. What's interesting in the insurance industry now is the fact that a lot of the traditional insurance products are not working well, and there's a lot of focus now on, for example, developing different types of hedging structures, such as parametric insurance. Have been involved in designing a hedging strategy for a major utility company, and that's a diagram on the right. And this aligns to your risk appetite. It's very important to understand the impacts of climate being a trend, and looking to when you're looking to design products, and solutions, how that trend is impacting on, in this case, on your revenues over a different seasonal impact, in this case a mild winter. So one of the critical challenges for risk managers is really how to integrate climate change into your existing IRM framework. So I'll go through this quite quickly, really. Just on the left-hand side, it's just highlighting that the three key areas of your framework, which is your risk strategy, your architecture, and your protocols. Clearly, in implementing climate change, you need to look at all three of those areas. But I think overarching issue that I've found within organisations is the lack of having a robust emerging risk management framework. So it's important to have a separate governance structure around managing emerging risks. So in organisations that I've worked with, like AIG, there's a separate emerging risk committee. So having accountability and responsibility is very important. Some of the new tools and techniques which are really important for risk managers to utilise are horizon scanning and stress testing. And I think there's a general consensus from regulators, from practitioners, that really the best approach is to design robust stress and scenario tests. And then what often is lacking, and where it's quite difficult, is that alignment between utilizing the outputs and integrating them into strategy and financial planning process. And this is something that TCFD has been pushing, which I'll come on to a little bit later, but as guidance to organizations to how to embed into planning. I think one of the key areas, for example, in the financial services sector that banks and building society are looking to do is change their products and services related to climate change. For example, in areas such as mortgages, because they are long-term investment vehicles and they have to integrate climate change into how they structure their products going forward, which they haven't had to do in the past. This is an example of, if you like, integrating horizon scanning and scenario analysis to sort of explain really the process that companies have to do. It's not that dissimilar to the financial crisis, when you have to think about developing discrete scenarios with probabilities. So if you think on the left-hand side, you've got various trajectories of emissions over a range from low to high, with a medium being sort of best case estimate. And then you have to superimpose some scenarios. Often companies are now utilizing return periods, for example, flood events, looking, say, 1 in 100-year flood over different time horizons. And that's I think a very powerful and important way of utilizing stress tests for looking at different threats facing your organization. And then you can utilize the outputs into your planning processes. So moving on to transition risk in a little bit more detail. This is obviously a very complex area. What I've tried to do here is just to highlight on the left-hand side key drivers of change, because actually standing still isn't a solution. There are lots of drivers for change. I've highlighted already emission targets. There are lots of international, national laws, reporting requirements, social adaptation, potential carbon taxes and pricing. Of course, these are the things you need to factor into your future scenarios as well. Policy changes that are coming down the line, and external stakeholders that I've mentioned. From an energy perspective, that's driving some specific issues, such as some positive things and negative things. Obviously, phasing out of coal plants, renewable energy support, sustainable investment products. The insurance industry is actually pulling out of providing insurance for certain types of assets, and as I mentioned, there's increased litigation risks. So that leads to a whole range of risks and opportunities for the industry. I think a lot of focus has been on stranded assets, and looking at balance sheets and whether those assets can be utilized, and maybe reductions in goodwill, and that's a huge issue for the industry to look at. The reduction in exploration opportunities, increased operating costs. But on the positive side, there's a lot of opportunities that also need to be managed. So I think as risk professionals, we need to be thinking about looking at both the threats and the opportunities, and innovation and technologies that are improving now, green financing, government incentives. And we're seeing that actually in how we're dealing with pandemics. So a lot of these government funded schemes are something that obviously risk managers need to be aware of to help improve risk in their organization. So on the right hand side, just really some of the summary really of some of the examples of the role of risk managers to support the transition risk and opportunities. I think a lot of regulators are really focusing on organizations and having somebody responsible to manage at senior level to develop a strategic plan on climate change. I think from my perspective, my experience, risk functions can really help organizations with deep dives and thematic reviews, and as I mentioned, stress testing. And at the bottom there, just risk training, really helping and guiding organizations providing training. One thing I would pick up on is risk appetite. You need to develop metrics to be able to monitor these risks across physical risk, transition risk, and you also need to really look at your risk appetite framework and strategy and adjust to make sure that you factor in climate change. So just the last slide is just to highlight the fact that the TCFD has provided some good guidance, and that's something I'd recommend you look at. And really just my last point was to say, sorry, I've probably gone over time, but really just risk knowledge and insights is critical, and risk managers play a pivotal role in delivering information that boards need. So that's, sorry I've gone over there, but I thought it was important to really cover the
certainly a different perspective. That's great. Good. Thank you very much, and thank you to the three speakers. We're moving into the panel now, which Alex will moderate. And also, I've got a few questions here, Alex. So just as you go through, and I've got a few that have been queued up here, and you may have some too.
Okay. Well, why don't you just share the questions that you have picked up already then?
Okay, thanks. Well, one is, this is one for Gavin, and Chris, I think, will have some insight as well, some perspective on this. So what trend are you seeing from oil and gas companies in terms of moving towards carbon capture and non-carbon businesses?
Yeah, I think yeah, the majors have been doing this for a number of years. And just in the last week, Shell announced that they had committed to net zero by 2050. We've seen Eni, Total, BP, particularly European majors, been very active in that direction. I don't think this is necessarily tied in with the current crisis that we're in. It's not excluding the current crisis, but it's not necessarily tied to it. It was happening beforehand. And I think it's around a number of themes. It's about remaining investable. It's about access to capital. It's about what investors want to see. It's about host governments. It's about the companies trying to get ahead of the energy transition and look at that move towards electrification, towards renewables, and away from very carbon-intensive projects. It fits with all of those things. Now, I think an interesting debate right now is, does the crisis we're in currently, does it accelerate or decelerate the energy transition, and hence these types of investments? You can take different positions on this. You can say, look, we're going to deglobalize, we're going to travel less, and we're going to see a lot of stimulus money coming into all economies, and that needs to find a home, and it will find a home in greener projects, in the same way that in 2009, a lot of stimulus found itself a home in US tight oil and shale oil. You could also take the view, of course, that very low oil prices, that the demand for individual cars to travel on your own to avoid public transportation, keeps oil demand pretty strong. And the trends. The trends have yet to be seen, really. I think we haven't come out of the crisis, so I don't know. But my view and the Wood Mac view would be that we probably are not at peak oil anytime soon, but that every investment that oil companies makes will go through a carbon lens and an ESG lens and an investability lens, a cost of capital lens. And so, those more carbon-intensive projects, those projects which have issues around social license to operate, just going to be tougher and tougher, and won't move ahead. I mean, Chris, I'm sure you'll have a view as well.
Yeah, look, I mean, Gavin, I think you summarized it extremely well. I think there is this question right now in the minds of people: has energy transition been accelerated or decelerated? And I think in a theme that we all like to talk about, which is like the flattening of the curve. I think if anything, this might have flattened the longer term demand, but might have pushed out the peak a little bit further. And so now I think oil industries have this dilemma when they make investments. At what, how flat is that curve going to be? When is the peak going to be? So they will question a little bit more those capital investments, and are they getting closer to that peak? And I think it's yet to be seen how consumers respond to the consequences of coronavirus. Do we all say we love the blue skies, the fresh air? Or to Gavin's point, which I absolutely agree on, is do they say, I don't have mass transport, I want to jump in my car more? And we also know what happened in 2015 when we had low oil prices the last time. We went from 11% sales of SUVs in the US up to 48%. So people bought bigger cars, that consume more. Now, I think this time it's going to be different. The unemployment is huge. I think it's going to have an impact, but again, it's the more wealthy that make those choices. So will they buy the EV or will they buy the SUV? So there's going to be I think, we shouldn't jump to conclusions too early with what the impact is. What I think is interesting is that when we look at the capital reductions that these companies are committing to, we heard about 25% reduction in capital, 25 to 30% that they're cutting. None of that is in upstream, and it's not cutting their renewables. Now, their renewables investment was woefully low, you could argue, at below 5% of their capital. But if you take 25% out, which was going to upstream, but keep your capital in your renewables the same, all of a sudden it looks like a big number, because it's more like 25% of their or 20% of their capital investment going into it, yet it's actually no more money. So I think an interesting one to watch. The last thing I might make to Martin's points that he was making, which was, I also think there is going to be less capital available for renewables. There's going to be less regulation and subsidies available for renewables. Although I want it, I think this is going to damage the banks. Have less capital to spend, the governments have less capital to spend on this, so there won't be the same level of impetus that might have been there had we not spent all this money basically nationalizing self-employed, nationalizing small companies by providing government-backed there is a danger that we will not have the same fiscal stimulus behind energy transition items.
I mean, I think we broadly agree, Chris. But I think there is enough money available to the alternative energy sector. It's not really been a shortage, So whether there's slightly less, doesn't necessarily slow down the pace of capacity build or inventory build. I think your point around transportation is really on the money. If people are going to buy an EV, if you're sitting at home 12 months ago thinking, I'm going to buy an EV, right? I'm going to get on this journey. You may well not buy that EV now because you're looking at your bank balance, you're looking at your job security, but you're still driving your internal combustion engine. And whereas previously, and you're exactly right, where people went out and bought SUVs, I agree, I don't think they necessarily do that. But they may just continue to drive an internal combustion engine car for what they last 8-10 years, something like that. The impetus to change,
20.
the motivations to change. At 20, well, there must be a few people still with 20, but it doesn't disappear, and I think that is the challenge to the pace of the energy transition. And I suspect we might be singing from the same hymn sheet, but I don't think we're doing it purely out of self-interest. The role of hydrocarbons does not disappear through the crisis that we're in. It changes. We probably have lower long-term oil demand growth. But we don't. I was asked by a journalist this week, is this year peak oil demand? No, I don't think it is. Right. I think we still need oil. We still need gas, certainly.
Well, if this year is peak oil demand, then actually 2019 was peak oil demand.
Well, then 2019 would have been peak oil demand. That's exactly right. So, yeah. So I don't agree. I don't agree with some of the some of those scenarios. Not at all.
A question came through here.
And just one little point.
On you go.
No, just one point I would make is we have revised our demand for jet fuel down. We had 2% growth year on year. We're now down to 1% year on year. It still grows though, but it is half the amount of growth that we had before. So there are some things that I think you're almost definitely, but let's not forget there's still 150 million people every year entering the middle classes who want to have access to wealthier living standards. and we shouldn't deprive them of that. And that is the big challenge we have. Sorry, Alex.
Yeah, I have a question here around the fact that obviously there's various break-even points globally. It was mentioned in one of the presentations. And the question is around, obviously there's going to be a lot of bankruptcies, a lot of organizations going out of business. Are we going to see a ramp up of mergers and acquisitions? Does that also feed into renewable energy companies being bought up? And how does that all link in is the question.
Yeah, if I could take that. I mean, yeah, in terms of bankruptcies, in the US lower 48, we've only really seen one significant bankruptcy so far.
Whiting.
So with Whiting, that's right. So that's going to take a little bit of time, and there's reasons for that. Companies are operating on short-run marginal cost. They're hedged for a certain period of time. They have things like minimum volume commitments that they have to continue to produce for, and plus, if you're really under financial stress, distressed operators are less likely to shut in wells or even choke back production because they need that cash flow to pay, if not all of their debt, certainly some of their debt. So I don't think we're there quite yet, but we know that the stress will come. And how much can you cut? How much further can you cut? US lower 48 operators were already pretty we're pretty lean, and the fact that a lot of their financing was based on reserve-based lending and revolver utilization of debt, which is very different to conventional oil and gas production, raises questions. To your second point, Alex, around buying up renewables companies, these companies are very different kind of investments for. Take the majors, for example. So you're looking at lower IRRs, stable cash flow, long-term cash flow, the kind of cash flow that doesn't get investors particularly excited who are used to strong dividend payments and buybacks to boost share prices. So I think we'll continue to probably see some activity, but I don't think we necessarily see a huge buying spree around renewables companies. Electricity demand, of course, has held up reasonably well relative to oil demand because people are at home watching Netflix and so on, and webinars, of course, like this. So it's a slightly different story to transportation fuel demand.
A couple of maybe just adds I might make there. I mean, number one is $11 billion of bankruptcies last year in the shale industry. I expect it to be higher this year, without a doubt. But that doesn't lose production. It does lead to consolidation. I think there will be consolidation, and I think that's the opportunity for the majors coming up, will be to do more consolidation. What is happening? I agree with some of those revolvers that Gavin talked about, but there's $20 billion of debt maturing in 2021 in the US shale industry, $30 billion in 2022. And if you look at the where the sort of credit ratings are going, of course, we have the ratings group. 23% of the industry was on sort of what you call high yield, low credit ratings. Now it's over 90%. Everybody is, the industry is really in that high yield. And if you're in the high yield sector, your borrowing cost isn't the 3 or 4% we may be thinking about. Their borrowing costs are in the 23, 24, 25% type level. So the cost of refinancing that debt is hugely expensive right now, and I think that's going to put a lot of pressure on. The bit on renewables, I think, is just a slight nuance to what Gavin talked about is, indeed, if you can get a 3 or 4% on a renewables company versus negative bond rates, actually investors are quite happy. They're very safe bets. But the reason why they're safe bets was because of the feed-in tariffs. And governments will not do feed-in tariffs. They can't afford them anymore. And so therefore, I think the risk profile of renewables has changed dramatically. And that is a headwind that I think is a challenge, especially as most of the renewables up to now has been put in places with good wind levels, good solar levels. And the next level is going to be going somewhere which is not as windy, not as good for solar radiance, and therefore your yield's going to be lower and more challenged. So I think there are some headwinds there.
you know, it's a key point. It's a key point is that what we look at a lot with renewables is the levelized cost of generation, the levelized cost of electricity. And for a lot of renewables, that is not where the demand center is. So your load center and your demand center are apart. So you can generate very low cost electricity, but you have grid to offtake that electricity and take it to the demand center. So, you know, be careful what you're buying. I don't think we necessarily disagree, Chris, on the point around the companies in the lower 48. I think my point was more around it on a short-term basis. If you're hedged and if you're just operating on your OPEX, you'll still produce. Okay, you're not disappearing tomorrow. But when you start talking 21 and 22, then the picture changes.
And that's very true. I mean, there's nothing hedged out into 21, 22. They've not taken the advantage of the spikes that we've had, so they've missed the boat there. So I think, the reckoning is coming, and it's probably not going to be the same recovery as we saw in 2015, 2016 this time round for sure. But yeah, indeed, agree there.
Yeah.
So I think we've got time for another question here. A question came through: with a massive reduction in energy-related activity, are there any observations on potential impacts on climate?
Well, I mean, I think there's other ways. I mean, we could talk about the impact on climate here. I mean, the first thing that, actually, just to continue on that piece around renewables, what we found is that we've reduced the generating capacity or the generating use of coal, nuclear in France right down, but in fact we've found that we can have a higher percentage of renewables in the mix. So there's a positive there that might be that we've learned how to use more renewables in the mix and have a stable energy demand. The problem is, I think, I'm sure Gavin would pick up if I said that, is, well, you've got a lot of industry not operating, so you've shaved away some of the peaks and troughs so it is easier to cope. But I think there's far too many people looking at this and saying, wow, this is great for the energy transition, it's perfect. The financial state of the economy, I think, is going to create some headwinds. We are going to see that as being a big issue for the next phase of growth. But in the short term, yes, I mean, clearly people are not driving, people are not taking flights, and those sort of things are positive. On the other hand, we see very strong demand for gas oil from light duty vehicles, because everybody's having their stuff delivered. And you show me an electric vehicle coming to deliver it. Yes, we've heard the deals that Amazon's looking to do to electrify its fleet, but that's some way off. So again, in the short term, that's creating more demand. And the other interesting thing we've seen right now is LPG demand has been relatively strong versus everything else, partly because we had some cold weather, and so everybody's at home heating their houses, which where they use LPG, or in places like India, they're using much more bottled gas for heating and cooking than they would if they were going into the offices. So you have this sort of interesting extra demand there. So there's winners and losers around this, but right now I don't think it spells a clear shift in the transition, and if anything, I think a weaker financial market, weaker capital markets. I agree, Gavin, there's plenty of cash out there, but I think it's going to be more constrained. Less money in governments to subsidize means there's going to be less impetus. If you could put the amount of money going into trying to solve the pandemic into solving a transition, wow, you could change things fast. But I'm not sure governments is going to have another big bulk of money to do the same as they've done to the pandemic.
That's a great point. That's a great point to finish on, I think, is to say that there's money in the system. We know that, and there's even more now because of stimulus. Where is that money going to go? Right now, the obvious place it's going to go into is things like healthcare. It's things like medical investment and so forth. That's where the attention is. Is it going to go into energy? Is it going to go into energy transition type technologies? My instinct 2 months, 3 months into this is probably not. And we have low cost hydrocarbons. We have a global energy system that is set up to utilize hydrocarbons, and so I don't think we're running away from that anytime soon.
Martin, that was a good comment that Chris ended on around the the effort put into the pandemic versus climate change. What's your group been talking about with regards to that? Has there been any discussion around that? The fact that so much effort and damage to the economy has been put into the whole pandemic situation, which proves that we can do it. People are working from home, which proves we can do it. What's being talked about in terms of the climate change and the views?
Well, I think, as I mentioned earlier, there's a big difference between the pandemic because it's a crisis that's now, and of course climate change is more of a long-term issue. Obviously it's your point about the money that's being spent, I suppose, on it. I mean, it's something you just have to do. It's a crisis. We're trying to. So I think there's a balance now between, and obviously a lot of governments are now saying, well, let's try and move out of the lockdown because they're looking at this balance. And everything in risk is about balance. So you're trying to balance the economic impact versus the impact on lives lost and the healthcare issues that we're facing as a society. So that issue is something obviously all governments are looking at now, and trying to come out of this lockdown. At what point is the right time, and getting the timing right is really, really a key issue now. But that's all about balancing risks and risks around the economic impacts. Of course, the knock-on effects of this are actually having some additional health risks. So it's very complex. So this forward planning, and the point I was, around, for example, using scenario analysis, I think it just highlights the importance of now factoring in all these different permutations to make the right decisions for governments, for organizations. So in terms of horizon scanning, scenario analysis, you can see how relevant it is.
Thanks very much. There are a few more questions, but we need to move on because we've got the survey results that I'd like to share on COVID-19, how it's impacted the energy industry, and a few comments about the special interest group itself. If there's still time at the end, we might be able to answer a couple of questions. If the panel needs to leave, then that's also okay. We can pick it up later. So thank you very much to the panel for answering those questions. And I'm just going to move on now to share the. Are you able to see my slide on COVID-19 and special interest group? Excellent. Okay, so thank you very much for the presentations, all very relevant, questions and answers very relevant. And I just want to cover now the fact that energy demand was forecast to grow over the next 20 years. It's been driven by developing countries' population growth. I think that was also mentioned just now in the Q&As. But of course, this was before COVID-19, and things have changed now as we've been discussing. Funnily enough, it was mentioned in one of the presentations, but storing on these tankers at sea, we can see in February it was $20,000, and now we're talking about $200,000 to $300,000 range. So what I really liked about the presentations we saw was it's not just about the oil price, there's everything else that comes with it. It's all the politics that come with it. It's all the other additional costs that come with it. It's how it impacts the economy in general, how it affects demand and supply. So really good to see all of that captured during the various presentations. So we did a survey with energy companies, and it's just preliminary at the moment. However, looking at how the following events compared in terms of impact on organization, you can see on the very left there that the highest impacts are, funnily enough, COVID-19. COVID-19 has actually had the largest impact on organizations of the organizations that answered here, followed by the current oil price range. Now you'll notice third is the global economic crash of 2008. So the question I have is, we're already seeing two of the biggest events happening right now. and we're expecting a global economic crash. We might even be seeing it already. So when you have all three of these impacting at the same time, the question is, how do we cope? How do we manage with that? Some of the biggest impact that the survey showed was completing projects, financial loss being one of the larger ones, our supply chains being heavily impacted, and company viability, obviously with the financial loss that we're incurring, projects that are being either delayed or unable to complete, and obviously now with the oil price. Now bear in mind, this survey snapshot is before the complete crash of oil prices. So it's just gotten worse since here. Questions around have you reduced staffing levels? Well, we can see already some organizations have been reducing staff by up to 50%. Some have already closed sites. So again, we're seeing reduction in staff. Now, is that an opportunity? A lot of people are letting staff go, and it means that going forward, you might be able to pick and choose staff at with huge experience at better rates than you otherwise might have done. It depends on your organization and when you start recruiting. When we started discussing the pandemic and business continuity plans, prior to the pandemic, one of the questions was, did you have a well-established pandemic plan? Resounding no. Most organizations did not have a pandemic plan. They did have business continuity plans in place, but again, you can see it's just over 50%. Given the current events, how these influence and change your perspective on forward planning, for example, are you going to be updating or implementing pandemic management or business continuity? Resounding yes as well. I think this has been a real eye-opener for many organizations. Their pandemic plans were non-existent. Their business continuity plans were either not fit for purpose or not really fit for this kind of crisis. They might have been fit for a fire or a loss of a server room or a loss of one building, but for your whole business to be put at risk, for the fact that you now can't fly people in and out if you're on a shift work type basis. You might have planned for what happens if we can't get people in and out for a week, but for a month, for 2 months? What about 3 months? Are we ready for that? What about the fact that key equipment is coming from China or key contractors are coming from Italy, and now we haven't got that anymore? It's been stopped. Are we prepared for that? And I think that's why businesses are now beginning to see the need to have a bit more robust business continuity plans, using the scenario planning, as has been discussed several times and Martin mentioned as well. And it's not just about surviving this, it's about how do we thrive afterwards in this post-COVID world, as we've been discussing. And again, scenarios come into this. Some of the key actions that organizations are taking coming out of the survey again are budgeting around scenario planning. So how can we budget more appropriately for future crisis, for future events such as this, using scenario planning? So it's really positive to see that people are talking about this. Preparing for geopolitical instability, it's something we haven't really discussed, but how will these crises, both the COVID and oil prices, how will they impact the geopolitical landscape? Will there be instability? And probably there will be. It might not be in your specific region, but what about your supply chain? And this is where we need to look at, are we going to start looking at our supply chain more carefully? A lot of people are beginning to put into place pandemic monitoring systems. Well, it's too late now. It's happened, but maybe for the future, that's really positive. Or looking at pandemic monitoring system for when can we start operating again? Whilst the lockdown might stop, how are social norms going to impact, and how is the pandemic progressing? Because we know we don't have the vaccine anytime soon. Cutting staff due to government advice. So a lot of governments in certain areas are giving advice that you should be cutting staff over a certain age, for example. So a lot of organizations are forced to cut staff. Now, if you're cutting staff of a certain age, you're losing experience. A lot of other actions are purchasing laptops and screens and pandemic-related equipment just for this specific event. Now, there's a forthcoming article that Grant's putting together that is going to be linked to this survey. And please, if you're interested in this survey, please let us know, and you can also fill this in. It will really help in guiding the article as well as guiding the discussions going forward. It's going to look at, the article is going to look at energy transition, as we discussed already, the kinds of tools and techniques that we should be using, scenarios, pandemic plans, business continuity, and of course, risk management itself. How companies are going to be trying to get rid of the blind spots, because clearly COVID-19 should be a wake-up call. Strategies for reskilling workers looking to transition out or into the various sectors. And how we can drive the agenda on risk and crisis planning and communication at the top levels. So then the question is, what can you do, attendees and special interest group members? What is it you can do in terms of supporting the energy special interest group? Please take part in the survey. Join the energy special interest group. If you aren't already a member and you were just coming on due to LinkedIn, please do join the group. Connect with us, and when I say that, I mean all the speakers and myself. Please connect with us on LinkedIn as well as the group. There's a special interest group, the IRM special interest group on LinkedIn. And please offer to write articles and thought leadership pieces. We will try to get them published in the IRM magazine or other relevant journals. Now, I mentioned at the start that Grant is the deputy chair, I'm the chair. We're looking for a committee. We don't actually have a committee at the moment. We really want a committee to help drive things forward, and that's where you come in. I would really like those interested to put yourself forward by sending an email to either myself, Al at baldwinglobal.com, or Grant, who's at Turkey at theirm.org. Grant is also the chair of the Turkey group. Put yourself forward, provide a short bio, which committee role would most interest you, and your contact details. The types of, well, first of all, the committee itself, we want you to help mold the future of the energy special interest group and plan future events. And the roles and responsibilities currently available for the committee are content, so helping to engage people in writing articles or thought leadership pieces. We have a special events role, so someone that can put these kind of special events together, maybe an annual conference with the support of the rest of the committee. The networking events, so we want to drive this forward by having regular networking events where everyone can have a discussion, everyone can network, everyone can have a good chance to share knowledge and what they're doing at the moment, what they're doing right now during the current crisis. As well as engaging members, someone that can be responsible for engaging members, trying to build the group up, and strategy and initiatives, how we can work with other special interest groups or regional interest groups, and how we can bring them into the Energy SIG as well. So again, please send your emails if you're interested with your short bio and which roles you'd be interested in, and hopefully we can get a committee together to really drive future meetings forward. Now, there are still a few people left. I don't know if the, let me just stop sharing the screen for a second here. I don't know if the panel have anywhere to go just now, but maybe we can answer one or two of the last questions that were there. Yeah? Okay. Grant, do you have a list of those questions? I'm just struggling to find them here.
Right, okay. Just goes back into that. Yeah, okay, there was, yeah, you got them now?
Yeah.
I just saw one that's very relevant. Most risk registers include pandemic. Do you think scenarios were not extreme enough, and how has this affected responses to COVID-19?
Just a very brief one from me. I don't think they've been extreme enough. I think we get into our comfort zones of what's realistic, and we ignore the bigger ticket items and these sort of black swan events and emerging risks. Specifically COVID-19, the emerging risk, which everyone could see, we sort of ignored, but I'm not on the panel, so I'll let other people.
Can I just answer a couple of points on that? As I mentioned, it's very important to have a separate emerging risk register, which I've seen in larger organizations, and then do deep dives. So when you start doing scenario analysis, so actually the regulators in the insurance industry actually asked companies to look at the impact of a major pandemic on their organization. I think the difficulty, for example, say in the insurance sector, is generally the scenarios are based on their own underwriting lines of business, rather than necessarily focus on the operational side, which is really where this has had a big impact. So to Alex's point, you are looking to develop realistic disaster scenarios, so tend to be sort of 1 in 100 year, 1 in 200 year. This is very much an outlier, a very, very extreme event, and operationally it'd be difficult to actually, you know, for the risk management profession to really model all these sort of very extreme scenarios. However, I think doing a deep dive and doing stress tests on realistic pandemics type scenarios is very important on organizations, and I think a lot of organizations haven't done those in the past.
Yeah, absolutely. I agree with you, Martin. I mean, I think you maybe don't need to even go into a deep dive, but certainly when oil prices were high, having the scenario of what if oil prices fall below 30 for a significant period of time, having that conversation in a high level strategy, you know, you should be having those conversations. And I know organizations that have actually gone into detail and had strategic plans so that if that happens, we're ready from day one. We know when to buy equipment, when to stop projects or slow down projects, who we can pull off the projects, who we can reallocate to other projects if need be, and it was just a smooth transition if it happens.
Look, I can add a minor comment on here. I mean, I think every company does planning for high and low oil prices and has scenarios. I think, you know, what you have to realize is the shape of this pandemic is something that I don't think anybody properly prepared for. They did preparation for, you know, business continuity plans, etc., but a shape of something where, you know, we've had the 9/11s of the world, so we know a little bit about what happens there and how it impacts the slow return of people back to play. We've had SARS and we've had MERS, and we can look at those and we have some experience of that, but no one's ever really experienced something as deep and as this. And, you know, so I think, you know, people always say, what are your analogies to this? Is it the great financial crisis of 2008? Not at all. That was a, you know, activity still continued. The best analogy I always say is, look, the world wars are the best analogies you can have. People were locked up at home, they had to change their behaviors, but you had a whole lot of energy demand that was being generated by a war, unfortunately. And this is completely, you know, so even this isn't the same. What will be similar is the way in which we go through the recovery of the cost and impact of the pandemic and take time to recover. And I think that's the one thing I would caution, is if people are thinking of the V shape or even the U shape, actually look at the world. It took time for people to recover. It took time for employment to come back. And that's perhaps really where we have to be now, is perhaps the industry has been a little bit slow in thinking there's talking V shape. Even IMF have been slow on that. Now we're talking about L shape. I mean, every letter in the alphabet is getting used. I tend to think of it as a squashed W is the best way to describe it, because we're going to probably get some second waves until the the vaccine is developed, which will be not until next year where there will be any large use of vaccine. So we're likely to go through some little bit of repeat events, and so we're going to still see this going. And are we reacting on that basis? I suspect we're all hoping that by the summer we're all going to be back and going on our summer holidays. If you're in the Northern Hemisphere, I suspect it's not going to be quite as good as that.
I think that's exactly the right point to make. I think it's the rosy view of, oh, we'll be back. I think we're in a continuity situation right now, so we almost need to be doing continuity within the continuity. It's almost like, well, how are we going to last? And that's where I think some organizations are better than others. I know there's organizations that a week into the crisis were going out of business. Now, I'm sorry, but that's not very good management of an organization that you cannot last a week without operating. Unless, yes, you're on sort of small margins, but you know, in the same industry, you've got other companies that can last 3, 4, 5 months. So I think there needs to be some rethinking there.
Just Alex, just to bring in the point about the linkage between the financial crisis. Post a financial crisis, the banking industry and the insurance industry spend an awful lot of money and effort building internal capital models, building capital buffers for these types of events, but not necessarily this extreme event. Now, they've held up quite a lot better now, and actually the banking sector is actually an industry that's helping, and the insurance sector is helping us getting out of this pandemic, because they were actually forward thinking and actually built in stress scenarios into their business models. So I do think that if you look back, that's a really interesting insight. And I think resilience, companies now realize they have to be more resilient for these types of events. But I think this type of event really is very much, I mean, one of my last roles, we had a big medical insurance division, but ultimately the government would actually pick this up because it's a global pandemic. So a lot of these types of, you know, this type of risk wouldn't be something that the insurance industry would be expected to pick up. It's a very much a societal issue, and governments need to step in these types of scenarios.
Grant, should we finish this, or do you think do you have any other questions from any relevant questions that you saw? Sorry, I've lost my questions. It popped up,
yeah,
and I haven't got it anymore.
There's probably only one other good one, but I'm very mindful. Gavin's in Singapore, and Gavin and Chris have both, and Martin have generously given of their time. So I think we're really in their hands for it.
I think let's wrap it up. It's been 2 hours. So thank you everyone who attended. Thank you very much to the speakers, Gavin, Chris, and Martin. Great topics and great insights. And I hope that everyone attending got a lot out of it. And hopefully this is something we can work on going forward with your help. A big thank you as well to Grant, who really helped put this whole thing together. Initially, I had an idea, let's do an event. Grant and I put together some thoughts, and then I got really busy, and luckily Grant was there to pick up the pieces and put the event together. So thank you very much, Grant. And this is exactly why we need a committee to help support us and drive things forward and have some ideas. So hopefully going forward, we'll have much more input from the rest of the risk management in energy community. So thanks again to the speakers, and thanks to everyone who joined. Until next time.
Thank you.
Thank you very much. It was great.
Thank you. Bye.
Stay safe, everyone.